All right, understanding loan to values or loan to cost when it comes to SBA 504 loans. So SBA 504 loans can do a total of 90% LTC, loan to cost. However, if it's a startup, it's going to be a 5% haircut, meaning you're going to be limited to 85% of total project cost being eligible for SBA financing under the 504 loan. That brings a good topic up. Sometimes if it's a startup and a special purpose property, meaning like a gas station, usually it's only got one use of this particular property, then it could be deemed special purpose. So if it's special purpose, you're getting dinged 5% on the LTC. And if it's a startup, you're getting dinged another 5% on the LTC. So you're then stuck at 80%. This is the reason sometimes I switch to the 7A, because they don't look at it the same way, and we could potentially do up to 90% of total project cost. So comparing the 504 and 7A, that is why sometimes when we're looking at a deal in the beginning, we got to kind of figure out, does it make sense as a 504 versus the 7A? From an LTC standpoint, from a loan to cost, how high of leverage can we do? But also, when you're in the 504, it's going to be a longer prepayment penalty. Now, your fixed rate terms are typically superior on the 504. But what I'm doing for many clients right now is we're structuring a fixed rate 7A option, and those rates could be right now just about 9% to 9.5%, depending on the bank, on a 7A fixed rate option. So sometimes that makes more sense. Now the 504 rate on the second loan, today's in November, is at 7.01. The senior debt's probably somewhere in the 8s or maybe 7.75. So your blended rate is definitely better. But remember, there's a little bit more cost involved on the 504, more time, and then you have a 10-year prepayment penalty on the SBA piece, or the second loan. First lien is negotiated with the bank. So some of the reasons why we may pick one product over the other. Now, if it's a bigger total project cost, $12, $13, $15 million, that's typically going to be a 504, because you can have a second as large as $5 million, and if you do a 504 green, it could be as large as $5.5 million, and then you can have a senior debt, so you can have a $8 or $9 million first and a $5 million second, or even a larger senior piece. So you can do bigger projects with the 504. So many different kind of use cases. I get this question all the time. What's better, the 7A or the 504? And typically we walk through the scenario, and then I show you the pros and cons of each. Maybe the 7A might be a much easier underwriting process because it's only one underwriting process versus two. But these are all the things that we take into account to determine what's the best way to go after this deal from a financing perspective, and also, ultimately, what are the plans with the business and the property. Anyways, hope you enjoyed this episode, and we'll see you on the next one.
Meet Bo Eckstein, the driving force behind Business Ownership Coach, unlocking the path to business ownership. Visit www.businessownershipcoach.com. Thrive with Business Ownership Coach.
Hey guys, Bo Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.